What's up everybody, Gen X Dividend Investor here. In this subscriber requested video, I discuss some pros and cons of investing in dividend ETFs versus single dividend stocks. I've also created a helpful spreadsheet I'll be reviewing with some info on dividend ETFs that you can either screenshot or make a copy of by clicking on the link of this Google spreadsheet in the description of this video, and then go to the File menu and select Make a Copy, and that will make a copy of it on your personal Google Drive. Feel free to jump to the timestamp on the screen if you just want to see the spreadsheet review, but you'll miss some good info if you skip ahead. So if you appreciate when I do videos based on what you guys request, as well as give you free spreadsheets, then please do me a favor and slam that thumbs up button, subscribe if you haven't yet, and poke that bell notification. So let me give you my TLDR. If dividend stocks are blondes and dividend ETFs are brunettes, then which would I rather date? My answer is I'd be happy to date both of them, if I weren't married of course. Seriously though, a common question I'm asked is why I don't invest in ETFs, even though I often say the best bet for most people is to simply invest in something like VTI or VOO. Well, I actually did go all in on VOO once, which I talked about in my video called The Time I Sold All My Stocks, but there are a bunch of reasons why I personally stick with individual stocks, including because I get a lot of enjoyment in owning individual businesses, aka stocks, as opposed to owning baskets of individual stocks, aka ETFs. I love going to McDonald's with my family knowing that I literally am an owner of that wonderful business, and while that would still be true if I owned VOO, it doesn't feel the same to me. I also enjoy staying on top of how my individual companies are doing, what products they're releasing, what execs they're hiring, what strategies they're adopting, etc. Owning single stocks has been a strong motivating force in my life, and that motivation has helped keep me investing for over 25 years. It's almost impossible to consistently beat the market with single stocks, but I've also never obsessed about beating the market. As long as I'm roughly in line with it, I'm good. So sure, I kind of seek alpha, which means choose investments that have the potential to beat the market, but honestly, if I underperform a bit, I'm still okay. That being said, I did do a video on how my portfolio has performed relative to the market, and I'm happy to say that my portfolio is performing well, and if I saw I was really underperforming the market over longer periods of time, I would rethink things. Anyways, an ETF, aka an exchange-traded fund, is basically a ticker made up of multiple companies, rather than just one. Some people think of some ETFs like ready-made portfolios because they can buy just one share of their ETF and they basically get a ton of fractional shares of various companies. I'll give you an analogy. If I turn my dividend portfolio into an ETF, let's call it ticker Gen X, even though US exchanges are limited to 4 characters, then if you bought one share of Gen X, you would effectively be getting fractional shares of all the 26 stocks in my portfolio, including Microsoft and Apple and J&J and etc. Now to be clear, while you could sell your Gen X share and then take that cash and buy whatever stock you wanted, you couldn't automatically turn your Gen X share into all the stocks that it makes up, i.e. there isn't the automatic ability to turn your ETF into all of its underlying shares without buying each stock individually. Anyways, some people prefer the simplicity of investing in ETFs so they don't need to spend a ton of time researching individual stocks, as well as they don't have to worry about what percentage of each stock should be at in their portfolio, and ultimately they should be getting good market returns, which historically are great. Most people who invest in ETFs just keep dollar cost averaging into them rather than figuring out what a good price is to invest in them. The better investors tend to figure out intrinsic value of their single stocks and then only buy when they're inexpensive. So getting into broad market ETFs can give you instant diversification of your portfolio, which should provide some protection against being overly exposed to a company or a sector that falls out of favor. To diversify single stocks, you need to own multiple, across various industries, etc. I did a video called How Many Stocks You Should Own, if you want to hear what the experts recommend. The price of an ETF changes throughout the day relative to all its underlying stocks. There are things you still need to research and understand about ETFs. Some ETFs track an index, like the S&P 500, or a sector, like industrials or real estate or whatever. For example, VNQ is Vanguard's real estate ETF, so it has a bunch of stocks that are all in the real estate sector, and it holds other funds in it. If we look at VNQ's top holdings, we see that number 1 is the Vanguard Real Estate 2 Index Fund, ticker VRTPX, and it has American Tower Core and Prologis and some others. Of course, if you buy an ETF that is tied to just a sector and not the broader market, then you'll probably want to own multiple ETFs to ensure better portfolio diversity. A well-known ETF that tracks the S&P 500 is Vanguard's VOO, which is considered by many to be a solid investment if you want to match the S&P 500's returns. Here's a screenshot of some of the stocks in VOO. We see that VOO currently holds around 500 stocks, with Apple being about 6.1% of it, Microsoft 5.7% of it, Amazon is at 3.8% of it, etc. VOO pays out dividends via what they call distributions. VOO pays out distributions every 3 months, aka quarterly, and the last payout was on July 2nd and they paid out about $1.33 per share that you own. To calculate what VU's dividend yield is, we take how much dividends it pays out in a year and divide that amount by its current share price. So the ideal way is to add up all the quarterly payouts in a calendar year, but if there isn't massive fluctuation between each payout, then to approximate yield you can just add up the last 4 quarterly payouts, or even just take the most recent payout and multiply it by 4 for an approximation of yield. So if we add up $1.33, $1.26, $1.38, and $1.30, and then divide all that by 413.86, which is what VU was out when I was doing this video, then we get VU's dividend yield, which is about 1.27%. If we just took the most recent quarter's payout of $1.33 and multiply that by 4, and divide that by 413.86, we get 1.28%. Thus you can see how both methods are a good approximation for VU's yield. That low 1.28% yield passes my sniff test for what I'd guesstimate for VU, since it holds companies that don't pay dividends like Tesla, Google, Amazon, and others. And of course it also has some big companies that pay dividends like J&J, Procter & Gamble, and Pepsi and such. You can also see that VU's distribution that they pay out changes each quarter, i.e. it fluctuates up or down, because the payout is based on all of VU's companies that pay dividends, any of which can be raising or lowering or etc. their respective dividend. And the people who manage ETFs like VU can be buying or selling stocks, further changing the underlying dividend payouts over time. An advantage of single dividend stocks that have a history of just increasing their dividend, like McDonald's, is that their payouts will only have gone sideways or up, rather than sometimes have periods of lower payouts. That doesn't mean they're guaranteed to always do that, of course, though if you over-index on those types of stocks, i.e. the dividend aristocrats or kings, then your portfolio will often have less volatility going down than ETFs have, though again any individual stock can still lower or suspend their dividend. So to summarize that point, ETFs tend to have variable dividend distributions which can make your payout go up or down each quarter or whatever time frame they pay out, whereas strong dividend portfolios tend to have payouts that only go sideways or up, but aren't immune to also going down occasionally. I like to see increasing payouts each year for strong dividend ETFs, like I do for dividend stocks. Another thing to be aware of about ETFs is that you have to pay fees to trade them, which is represented in a metric called an expense ratio. Thus, another benefit of single stocks is that they don't have expense ratios. Vanguard is known industry-wide for low expense ratios. VU's expense ratio is only 0.03%. The Vanguard High Dividend Yield ETF, ticker VYM, is another well-respected ETF and its expense ratio is also low at 0.06%. Another well-known dividend ETF is called Noble, which is an ETF focused on the rare companies within the S&P 500 that have raised their dividends for at least 25 consecutive years, aka the dividend aristocrats. Noble's expense ratio is higher at 0.35%. An expense ratio of 0.35% means that for every $1,000 you have invested, you'll pay $3.50 in annual investment fees. I feel anything under a 0.5% expense ratio is often reasonable. Beyond ETFs, we have mutual funds that are like ETFs, but are even more actively managed and thus tend to charge more. ETFs are mostly passively managed, since they're basically just tracking an index or sector, thus less management time usually means less fees. ETFs, like stocks, can be traded throughout the day, but mutual funds can only be purchased at the end of each trading day based on a calculated price. You should have seen the crazy expense ratios on mutual funds in the 90s. Anyways, fortunately, competition has driven down expense ratios. A simple way you can gauge how good experts consider an ETF to be is on Morningstar.com. Morningstar gives VU a great 5-star rating out of 5. They give Noble a 4-star rating, which is still good. An example of an ETF that Morningstar rates poorly is SPHD, which is Invesco's high dividend low volume ETF, which only got 1 star. Morningstar ratings are basically based on how the fund or stock has performed over time, with adjustments for risks and costs and such. So now that we get how ETFs work, you can probably understand why it's easier, smarter, and simpler to own an inexpensive, broad market ETF than it is to create your own portfolio of a bunch of individual dividend stocks. One potential benefit of building your own portfolio with single dividend stocks is that you can mold your portfolio towards whatever yield or dividend compound annual growth rate or beta or etc. that you might want. There are thousands of ETFs worth trillions in the US, but only a few hundred are dividend ETFs, and I read that ETFs overall make up 25% of all transactions on a daily basis. I did a poll on my Dividend Discord asking what people's favorite ETFs were. I took the poll results and made this graph in the spreadsheet, and you can see that SCHD was the most popular one at about 21%. Now let's go over the spreadsheet. Okay, here we are in the spreadsheet, and we can see the first column are just the tickers, the name of the fund, if it's a monthly payer or not, because people love those monthly payers, if it's covered call income, and then we have the number of votes it got in my Dividend Discord, the Morningstar rating, their yield, the 5-year dividend CAGR, which I pulled from Seeking Alpha, SA, The number of consecutive years of increases also from there, the expense ratio, the annualized return, which I got from Dividend Channel, and the number of years that they've had that annualized return. And then I came up with a scoring where 0 is white, 1 is red, 2 is yellow, and 3 is green. And if you want to see the rating criteria, you can left click and then right click, go to conditional formatting. So for the Morningstar rating, if it's less than or equal to 2, I gave it a red. If it's 3, I gave it a yellow. And if it's 4 or 5, I gave it a green. And you can check all those conditional formattings to see the ranges for what I consider a white or a yellow or a green. So right now this is just alphabetically organized, but I also have filters on each of these column heading. If I want to sort this based on Morningstar rating, you go up here, and if you sort it this way. If it doesn't have anything filled out, it means the data didn't exist yet. So in this case, Morningstar rates DGRO, which is iShares Core Dividend Growth ETF, and SCHD, the Schwab US Dividend Equity ETF, and VOO, Vanguard 500, as the highest rated ETFs. If you want to sort things based on dividend CAGR, you could see SCHD is up there with a 13%, which is amazing. And then we've got Noble after that. In terms of number of consecutive years of dividend increases per Seeking Alpha, we see that VYM is up top with 12 years, and VIG at 11, and SCHD at 10. In terms of expense ratios, we want the lower amount the better. So you can see in this case, the Vanguard things really do well with VTI and VOO and VYM. If we sort it based on the highest annual return, we can see that VOO is up there up top and then SCHD. So if we sort these based on scoring, and I didn't score QYLD, JEPI, and NUSI because they really are unique. However, people like them. And so I kind of left their scores blank, and I think those merit their own research. They have some kind of pros and cons. You can dig into those if you're interested in them. But based on the scoring system I came up with, so SCHD came out on top, and I can agree with that, and followed by VYM. If I was kind of just doing this myself without doing the scoring system, I probably would have ranked Noble higher up in the list. But I just kind of went with the data and without trying to, massage anything. So you can either take a screenshot of this, or you can come up here, come into my link, and then do File, Make a Copy, and that'll make a copy on your own Google personal drive. There are a few other things worth mentioning about ETFs. I personally tend to like ETFs that have large amounts of assets under management, because that often means that lots of people are investing with them, which also often means their volume, aka how much is being traded, is also higher, which is something else I like to see so that I can get in and out of a stock easily. To hear more of my thoughts on things like QYLD, JEPI, and NUSI, I recommend you watch my July 2021 questions and answers video. Before investing in an ETF, I would look at what stocks it holds to ensure it covers companies you want. Like SCHD is one a lot of people like, but the last time I checked it doesn't hold REITs, nor does it hold low-yield, high-growth dividend companies like Apple or Microsoft. Though you could always go with SCHD and then also go with the Vanguard REIT I previously mentioned, and invest in Apple and Microsoft. Anyways, an advantage of single stocks over ETFs is that you can choose to only invest in stocks that are in your circle of competence. Investing within your circle of competence allows you to leverage your experience and knowledge and invest in things you understand and know about, which increases your odds for identifying good growing companies. Like my background is in tech and tech management, so I became pretty familiar with Atlassian products, and ultimately I hold it in my growth portfolio. Atlassian isn't a company most investors have heard of, unlike Apple or Microsoft. Anyways, Buffett is someone who owns dozens of dividend-paying stocks in his portfolio, yet in his will he's said to put 10% of his assets into short-term government bonds and the remaining 90% in a very low-cost S&P 500 index fund like Vanguard has. He said that he believed that the long-term results of doing that would be superior to those attained by most investors, whether they're professionals or not. So even Buffett sees the simplicity and power of cheap passive indexing that some ETFs give you. Another thing to consider when evaluating ETFs are their turnover rate, which is how often ETFs replace their holdings on a yearly basis, i.e. how many stocks they get rid of versus add. Every time a fund manager buys and sells positions, it ups the fund's turnover ratio. So a 100% turnover ratio means that the managers bought and sold all their positions in the last 12 months. Index funds and most ETFs often have turnover ratios lower than 5%. ETFs with lower portfolio turnovers can pay less in capital gains taxes and potentially transaction costs, which can help in its returns, especially in taxable accounts. I'm not a tax expert, so I won't go into the various nuances of taxes with ETFs versus single stocks, but I recommend researching that to make sure you understand how they work. Generally speaking, I'd say that ETFs are somewhat tax efficient because they tend not to distribute a lot of capital gains. So I think if you're just starting out investing, then ETFs are definitely a smarter way to go. You can get great diversification right off the bat, and you can just keep investing and not worry about much else. You ultimately want to look for ways to reduce your risk while generating a great return. Individual stocks are riskier, but can yield higher returns. The market feels pretty hot to me these days, so it would be understandable to slowly dollar cost average invest rather than lump sum invest if you're sitting on a pile of cash. Then again, statistically it's been proven that most of the time it's smarter to lump sum invest. Side note, there's a growing number of experts who say that the ETF trend that has been very popular with people's portfolios will backfire. Speaking of portfolios, M1 recently raised their referral bonus to $50 when new US residents open an account per their requirements. This $50 promotion lasts until midnight on September 7th, and then they'll probably lower it back down to $20 or $10 or whatever, which is still worth doing if you don't have an account. The way it works is you click on my M1 referral link in the description of this video, and then either open a brokerage account and fund it with $100, or open a retirement account and fund it with $500. Deposits which need to happen within 30 days of you opening the account. Then you need to keep your initial deposit inside the new account for 30 days from the date of deposit to get however much they are offering. Now I'd like to shout out my latest Patreon aristocrats who have recently signed up, something I do because I really appreciate them for supporting my channel and my goal to help to educate the world to the wonders of dividend investing. So thank you Alcatraz, thank you Joe King Bro, thank you Sin, and thank you Tarko Bless. As Patreon aristocrats, they gain access to my dividend portfolio tracker spreadsheet, along with they gain access to multiple private channels on my Discord, including one where I let people watch my videos before I release them to the public, as well as I often let you vote on which thumbnails I use for my new videos. If you appreciated this video, then please kill that thumbs up button, subscribe if you haven't yet, and click that bell notification. I highly recommend that you join my free dividend Discord investing chat server, which has thousands of dividend investors on it from around the world. I work hard to keep my Discord filled with great people on it as I boot any toxic negative people off in order to keep it a fun, positive place to hang out. I also say no porn, no politics, no bashing others, stuff like that. It's a positive chat environment where you can learn and freely interact with other investors, and like my channel, I make sure it's high value even though it's free. Thanks for watching and clicking that like button, stay positive, and I'll talk to you again real soon. I am not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I am only sharing my opinion with no guarantee of gains or losses on investments.